You worked for 30, maybe 40 years, diligently paying into the system, trusting that your pension would be the golden ticket to a stress-free retirement. But what if I told you that very same pension is acting as a hidden trigger, quietly detonating a chain reaction of stealth taxes that could wipe out a massive chunk of your retirement income? The IRS has laid a trap so perfectly disguised as a benefit that 90% of retirees do not even see it coming until the tax bill arrives. My name is not what matters today. What matters is your money, your security, and protecting the life you have spent decades building. If you have a pension, or if you have substantial tax-deferred savings like a traditional 401k or IRA, you are in the crosshairs of a tax system that fundamentally changes the moment you stop working. Today, we are going to walk through the exact mechanics of what financial insiders call the retirement tax torpedo. We will cover the completely outdated 1983 IRS formula that silently taxes your Social Security, the 2-year Medicare delay that catches almost everyone off guard, the brand new 2026 Secure Act rules that are changing the game right now, and finally, the most devastating trap of all, which we will save for the very end. By the time this video is over, you will have the exact defensive blueprint to protect your income, keep more of your own money, and avoid the devastating mistakes that so many hardworking retirees make. Let us start with a concept that catches almost everyone completely off guard. Most people assume that when they retire, their income drops, and therefore their tax bracket drops. That is the traditional wisdom, right? You make less, you are taxed less. But the reality for a retiree with a pension is often the exact opposite, and it all begins with a little-known, highly punitive calculation called provisional income. This is the first piece of the puzzle, and it is the mechanism the government uses to decide how much of your Social Security benefits they are going to tax. Back in 1983, Congress decided that Social Security benefits should be taxed for higher-income retirees, but here's the kicker. The income thresholds they set back in 1983 and then updated in 1993 were never indexed for inflation, not once. 40 years of inflation have passed, making the cost of everything from bread to housing skyrocket, but the IRS thresholds for taxing Social Security have remained entirely frozen in time. Here is how this trap springs on you. To calculate your provisional income, the IRS takes your adjusted gross income, adds in any tax-exempt interest you might have, and then adds half of your Social Security benefits. If you are married filing jointly, and that total number pushes past $44,000, up to 85% of your Social Security benefits suddenly become taxable. Think about that number for a second. $44,000 in 1993. That was a very healthy income. Today, it is barely enough to scrape by in most of the country. And if you have a pension, you are almost guaranteed to blast right past that threshold. Your pension provides a fantastic floor of guaranteed income, which is wonderful for your peace of mind, but it also acts as a permanent, immovable foundation of taxable income. When you stack your pension on top of your Social Security, that fixed 1983 formula kicks in automatically, dragging up to 85% of your Social Security benefits into your taxable income pool. You are effectively being punished for having a pension. Let me ask you a question. Have you ever tried to withdraw just $1 extra from your IRA to pay for a vacation or a home repair, only to find that it cost you almost 50 cents in taxes? That is the tax torpedo in action. Because of the way provisional income works, taking $1 extra from your taxable retirement accounts can actually cause an additional 85 cents of your Social Security to become taxable. So your taxable income does not just go up by $1, it goes up by $1.85. If you are in the 22% tax bracket, you are suddenly paying an effective marginal tax rate of nearly 41% on that withdrawal. 41%. That is a higher tax rate than the wealthiest billionaires in the country pay, and it is happening to middle-class retirees simply because they have a pension and tried to pull a little extra money out of their IRA. This is why you cannot just look at your tax bracket in retirement. You have to look at how every single dollar you withdraw interacts with the rest of your income. Now, if you think the Social Security tax trap is frustrating, wait until you see how your pension interacts with the healthcare system. This brings us to the second massive trap, the Medicare IRMAA cliff. IRMAA stands for Income-Related Monthly Adjustment Amount. It is essentially a surcharge, a stealth tax, tacked onto your Medicare Part B and Part D premiums if your income goes over a certain threshold. Most people think of Medicare as a fixed cost, something you pay a flat rate for once you turn 65. But for retirees with pensions, Medicare is anything but a flat rate. Here's the most deceptive part about IRMAA. It operates on a 2-year look-back. That means the Medicare premiums you are paying right now in 2026 are not based on what you are earning today. They are based on the tax return you filed in 2024. The IRS and the Social Security Administration look into the past to determine what you owe today. Imagine you decided to do some work on your house in 2024, or maybe you took a big dream vacation, and to pay for it, you pulled a lump sum out of your tax-deferred 401k. That withdrawal spiked your income for that one specific year. You paid the taxes on it in 2024 and thought you were done with it. But now, in 2026, you get a letter from the government stating that your Medicare premiums are suddenly doubling or even tripling. And unlike normal tax brackets, which are graduated and progressive, IRMAA is a cliff. If you go just one single dollar over the IRMAA threshold, you do not just pay a little bit more, you trigger the entire surcharge for the entire year. One extra dollar of income could end up costing you thousands of dollars in additional Medicare premiums. And once again, your pension is the culprit that sets you up for this fall. Because your pension provides a high baseline of fixed income, you are naturally hovering right near those IRMAA cliffs. You have absolutely no margin for error. A simple capital gain from selling a mutual fund or a required withdrawal from your IRA can easily push you over the edge. You are forced to pay significantly more for the exact same medical coverage as your neighbor simply because you saved diligently and earned a pension. The only way to defend against the IRMAA cliff is extreme vigilance. You have to project your income years in advance, carefully managing every withdrawal and every capital gain, because a mistake made today will inevitably come back to haunt you 2 years from now. Did you know that over 60% of retirees fail to factor in healthcare surcharges when planning their withdrawal strategies? That is a staggering oversight, and it is exactly what the system relies on. It relies on you not paying attention until the bill is already printed and mailed to your doorstep. This brings us to the third piece of the trap, and it revolves around the new rules that are rolling out right now. If you are watching this, you need to understand how the Secure Act 2.0 is fundamentally changing the landscape in 2026. For years, the government allowed you to defer taxes on your 401k and traditional IRA savings. They encouraged it. They wanted you to build up a massive nest egg. But the government does not let you defer those taxes forever. Eventually, they want their cut, and they force you to start taking money out of those accounts through required minimum distributions, or RMDs. Under the new Secure Act rules, the age for RMDs has been pushed back. If you were born in 1951 or later, your RMD age is now 73. Eventually, it will push back to 75. On the surface, this sounds like a great deal. You get to leave your money in your accounts longer, letting it grow tax-deferred for a few more years. But for a retiree with a pension, this delay is actually a carefully disguised ticking time bomb. Think about what happens when you delay your withdrawals. Your account balances continue to grow. When you finally hit age 73, those forced withdrawals are going to be significantly larger than they would have been if you had started taking them earlier. So picture this scenario. You are 73 years old. You are collecting your Social Security. You have your fixed pension income coming in every month. And now, the IRS forces you to withdraw a massive chunk of money from your IRA, adding it directly to your taxable income. You have no choice in the matter. This massive influx of forced income stacks on top of your pension. It pushes you into a much higher tax bracket. It triggers the taxation of your Social Security through the provisional income formula we discussed earlier, and it blasts you right over the IRMAA cliff, causing your Medicare premiums to skyrocket 2 years later. It is a perfect storm, a synchronized attack on your wealth. Your pension acts as the anvil, and your RMDs act as the hammer, and your hard-earned retirement savings are caught right in the middle, getting completely crushed. And speaking of the Secure Act 2.0, there is another massive change hitting right now in 2026 that you must be aware of if you are still working and trying to pad your accounts in the final years before retirement. Up until now, if you were over 50, you could make catch-up contributions to your 401k on a pre-tax basis. This allowed high earners to aggressively save for retirement while simultaneously lowering their current tax bill. But as of 2026, the rules have changed. If you earned more than $145,000 in the previous year, the IRS is now mandating that all of your catch-up contributions must be made as Roth contributions. This means you must pay taxes on that money right now, up front. The government is doing this because they want their tax revenue today. They do not want to wait until you retire. This completely alters the late-stage tax planning strategy for high earners. You can no longer rely on those catch-up contributions to lower your current taxable income. It forces you to rethink your entire cash flow. While getting money into a Roth account is incredibly powerful for your future tax-free growth, being forced to pay the taxes today can create a serious cash crunch if you are not prepared for it. It is just another way the rules are constantly being rewritten to ensure the IRS gets its piece of your pie. But as damaging as all of these traps are, the Social Security taxation, the IRMAA cliffs, the massive forced RMDs, and the new Roth requirements, they all pale in comparison to the final trap. This is the one that breaks hearts and ruins financial plans in an instant. This is the trap I promised to reveal at the end, and it is the most insidious tax penalty in the entire American financial system. It is called the widow's tax penalty. I want you to imagine a married couple. Let us call them Richard and Mary. They have worked hard their entire lives. Richard has a healthy pension. They both collect Social Security, and they have done a great job saving in their IRAs. They file their taxes jointly. They enjoy the favorable married tax brackets, and they are living a comfortable, secure retirement. Then tragedy strikes. Richard passes away. Mary is completely devastated, grieving the loss of her lifelong partner. But the IRS does not pause for grief. The moment Richard dies, Mary's financial reality violently changes. First, she loses the smaller of their two Social Security checks. The income drops immediately, but because Richard had a great pension with a survivor benefit, Mary continues to receive that pension income. She also inherits his IRA, meaning she is now solely responsible for taking the required minimum distributions on all of that combined wealth. So Mary's total income has dropped because she lost a Social Security check, but her taxable income remains dangerously high because of the pension and the RMDs. But here is the devastating part. Mary is no longer filing her taxes as married filing jointly. She is now filing as a single taxpayer. The tax brackets for a single filer are roughly half the size of the brackets for a married couple. The standard deduction is cut in half. The thresholds for the IRMAA Medicare surcharges are drastically lower. Even though Mary has less money coming into the household than when Richard was alive, her income is now being squeezed into the much smaller, much tighter single tax brackets. She is suddenly pushed into a dramatically higher marginal tax rate. Her Social Security taxation hits the maximum 85%. Her Medicare premiums double because she is now blasting past the single filer IRMAA limits. She is paying substantially more in taxes on less overall income, all while trying to navigate the emotional trauma of losing her spouse. This is the widow's penalty. It is the most brutal, unforgiving trap in the entire tax code, and a pension is very often the primary catalyst that makes it so severe. Because the pension income cannot be turned off, it acts as a relentless engine driving the surviving spouse into higher and higher tax liabilities. The tragedy is that this does not have to happen. The retirement tax torpedo, the IRMAA cliffs, the RMD hammer, and the widow's penalty are all avoidable, or at least heavily mitigable, if you take action before the traps are sprung. You cannot wait until you are 73 years old to start planning for your RMDs. You cannot wait until your spouse passes away to start thinking about the widow's penalty. The time to build your defense is right now, during what financial planners call the window of opportunity. This window occurs in the years immediately following your retirement before your RMDs begin. During this period, you have unprecedented control over your taxable income. You might be living off cash reserves or carefully drawing down your portfolio, keeping your official taxable income relatively low. This is the golden era for tax planning. This is when you should be looking at executing strategic Roth conversions. A Roth conversion involves voluntarily moving money from your tax-deferred traditional IRA into a tax-free Roth IRA. Yes, you have to pay taxes on the amount you convert in the year you do it, but you get to pay those taxes at today's known rates, and you get to carefully control exactly how much you convert so you do not push yourself into a higher bracket or trip an IRMAA cliff. By moving money out of your traditional IRA during these gap years, you are systematically dismantling the RMD time bomb. You are shrinking the balance of your pre-tax accounts, which means when you finally reach age 73, your forced withdrawals will be significantly smaller. By taking the tax hit on your own terms today, you protect yourself from the massive forced tax hits of tomorrow. You protect your Social Security from the Provisional Income Trap. You protect your future self from surprise Medicare premium spikes, and most importantly, you protect your surviving spouse from the crushing weight of the widow's penalty, because any money inside a Roth IRA does not trigger RMDs and does not count toward provisional income or IRMAA calculations. It is a completely tax-free reservoir of wealth that your spouse can draw upon without any fear of IRS interference. You must view your retirement not just as an investment challenge, but as a tax management challenge. Your pension is a blessing, a fantastic source of reliable income that most people today will never have. But you must respect its power to disrupt your tax situation. You must coordinate your withdrawal strategy, your Social Security claiming strategy, and your tax strategy into one unified, cohesive plan. Do not let the IRS use your hard work and diligent saving against you. Take control of your financial narrative. To recap the most important takeaways from today: first, recognize that a pension forms a dangerous foundation that easily triggers the taxation of up to 85% of your Social Security through the frozen provisional income formula. Second, always remember that Medicare premiums are based on a 2-year look-back, meaning the financial decisions you make today will dictate your healthcare costs 2 years from now. Third, understand that delaying your RMDs under the new Secure Act rules can actually create a massive tax bomb later in life, stacking on top of your pension and crushing your brackets. And finally, you must plan for the widow's tax penalty, actively working today to ensure your surviving spouse is not left with a devastating tax burden on top of a heartbreaking loss. I want to hear from you. Have you been caught off guard by a surprise tax bill or a sudden spike in your Medicare premium since you retired? Have you started implementing Roth conversions to diffuse these traps? Go down to the comments section right now and share your experience. Your story might just be the warning someone else needs to hear to protect their own retirement.